There is a question on the screen. The Dwyer Company balance sheet indicates that the company has 2 million of 7.5% convertible bonds. Then we have 1 million of 9% preferred stock, par value 100, and 1 million common stock, par value 10. The company reported net income of 317,000. The bonds can be converted. These are convertible bonds into 50,000 common shares. Income tax rate is 36%. So these are the details that are provided for us. Which one of the following would Dwyer report as diluted earnings per share? See, from the data, we see that convertible bonds, as we have read that convertible bonds value is 2 million. The interest rate on convertible bonds is 7.5%. So on account of that, we see interest amount on convertible bonds is 150,000. Before we proceed further, let's do one thing. Let's just have a look at the income statement format for a better understanding. See the format. I have the format right here. See, we have the income statement from sales, cost of goods, and gross profit and all. Let's look at from earnings before interest and tax, EBIT. See, from the profit that is available to all the investors, debt holders as well as equity holders, the total amount of earnings that is available, out of that, first interest is deducted. Because interest is deducted, the earnings comes down, and on the reduced earnings, taxes are paid. So there is a tax advantage enjoyed on account of employing debt capital in the business. So as much as the interest amount is deducted from EBIT, the tax benefit is enjoyed to that extent. Then we have earnings that are available after taxes, which are available for both preferred shareholders as well as common equity shareholders. Okay, then the preferred dividend is deducted from earnings after tax. The balance of it is available to common equity shareholders. Okay, that is what the format of income statement, from the format of income statement we understand. So here there are convertible bonds to the extent of 2 million. Interest on that is 150,000. If 150,000 interest is deducted, the firm enjoys a tax benefit of 54,000, which is tax rate is 36%. At the rate of 36%, if 150,000 on that less tax is paid, that is 54,000 is the tax advantage or tax benefit of the firm. Other details are, we see the other type of capital preferred stock is there. Preferred stock is 1 million. Dividend on preferred stock is 90,000. So this is what we can understand. Now, if the convertible bonds are converted into common shares, then what happens? So we see that from the, now we have to calculate what is the net income that is reported after the dilution, after the conversion. So which one of the following would Dwyer report as diluted earnings per share? So first let's see net income. Net income, we have it as 317,000. From that, less preferred dividend. Preferred dividend is 90,000. That is 1 million into 9% is 90,000. So once this is deducted, the balance of it is net income of common equity shareholders. How much is available? So we see that 317,000 minus 90,000. 317,000 minus 90,000. That comes up to 227,000. If convertible bonds are converted into shares, then whatever was the advantage which they have received on account of interest and tax advantage of 54,000, they have to be cancelled out. So we see that earlier interest on convertible bonds of 150,000 was deducted. Then they have enjoyed a tax benefit of 54,000. That both of them have to be nullified. In that case, what do we do? So we now need to make adjustments for that. Okay. So whatever interest was earlier deducted now has to be added. Okay. Add back interest. Interest on bonds, which is 150,000. The tax advantage what they have enjoyed now is no longer will be available. So let's tax benefit. Tax benefit, see at the rate of 150,000 at the rate of 36% is 54,000. Okay, so that has to be adjusted. So this would be 54,000. Once we do that, this is net income shareholders. Inclusion. Let's just check this one. How much is it available? 323,000. 323,000. Okay. So the number of common equity shares are, see the other details, we have it as common stock. Common stock is 1 million. Par value is $10. Number of common shares are 1 million divided by 10, which is equal to 100,000 shares. See, number of shares after dilution would be already 100,000 shares are there, plus additional 50,000 shares would be added, which is equal to 150,000 shares. Okay. Now, if we are asked to calculate what would be the diluted earnings per share. So diluted earnings per share is equal to 323,000 divided by 150,000. Is equal to $2.15. 2.1533. So in that case, the correct answer is B 2.1. I hope this is clear to you.